Before we begin, a quick note, this video is for educational purposes only. It's not financial or tax advice. The goal here is simple, to understand how the US tax system works and why outcomes can look very different for different groups of people. Now imagine this. Two people wake up on the same Monday morning in America. One is a school teacher earning around $60,000 a year. The other is a millionaire investor whose wealth grows even while he sleeps. By the end of the year, both will have made money, but surprisingly, the teacher might end up paying a higher percentage of their income in taxes than the millionaire. At first, that sounds unfair. Maybe even shocking. But here's the truth. This isn't about breaking the rules. In many cases, it's about how the rules are written, and how different types of income are treated inside the system. So what's really going on here? To understand this, we need to look at something most people never think about, the difference between income and wealth. For most Americans, money comes from a paycheck. You go to work, you earn a salary, and taxes are automatically taken out before you even see that money. This is known as earned income, and it's taxed at standard income tax rates. It's simple, direct, and unavoidable. But for many wealthy individuals, money doesn't mainly come from a paycheck. Instead, it often comes from investments, like stocks, real estate, or ownership in businesses. And here's where things start to shift. In the US tax system, different types of income are taxed differently. For example, long-term investment gains are often taxed at lower rates than regular earned income. This doesn't mean someone is avoiding taxes, it means they're earning money in a way that the system treats differently. That distinction alone can create a big gap over time. Now let's explore another important concept, timing. When most people earn money, taxes apply immediately. But with investments, taxes often apply only when gains are realized. In simple terms, that means when an asset is actually sold. So if the value of an investment increases, but the person chooses not to sell it, that gain remains unrealized. And under current tax rules, unrealized gains are generally not taxed. This doesn't mean taxes disappear, it means they can be delayed. And in finance, timing can make a huge difference. Another concept that often surprises people is how assets can be used without being sold. In some cases, individuals with significant assets may choose to borrow against those assets instead of selling them. Since loans are not considered income under tax rules, they are treated differently from earnings. Again, this is not about avoiding the system, it's about using financial tools within the rules that already exist. Now let's talk about deductions and structures. The tax system includes various deductions and incentives that are designed to encourage certain activities, like starting businesses, investing in property, or creating jobs. For example, business expenses can often be deducted from taxable income. This might include operational costs, equipment, or other necessary expenditures. Similarly, real estate investments may allow for depreciation, which reflects the gradual use of a property over time for tax purposes. These rules are part of the system, not exceptions to it. However, the key difference is access and awareness. Many middle-class individuals rely on straightforward income sources and standard tax filing methods. On the other hand, individuals with more complex financial situations often work with professionals, such as accountants and financial advisors, who help them understand and apply these rules more effectively. It's not just about money, it's about knowledge and structure. There's also a long-term perspective involved. Wealthy individuals often plan their financial decisions years in advance. They think about when to buy, when to sell, and how to manage different types of income over time. This kind of planning can influence how and when taxes are applied. Meanwhile, most people only think about taxes once a year. That difference in approach can lead to very different outcomes. Now, an important clarification. This video is not suggesting that one group is right or wrong. And it's not encouraging anyone to take specific actions. Every financial situation is unique, and tax laws can be complex and change over time. The purpose here is simply to explain why differences exist, and how the structure of the system plays a role. Because in reality, the tax system doesn't treat all income the same way. A dollar earned from a salary is different from a dollar gained through an investment. A personal expense is different from a business expense. And understanding those differences can change how you see money as a whole. So what can we learn from this? First, awareness matters. The more you understand how financial systems work, the better equipped you are to make informed decisions. Second, structure matters. How money is earned, held, and used can affect how it's treated. And third, long-term thinking matters. Financial outcomes are often the result of consistent decisions over time, not just one moment. At the end of the day, this isn't about shortcuts or quick wins. It's about understanding the system you're already a part of. Because once you start to see how it works, you begin to see opportunities to think differently, plan smarter, and move with more clarity. If you want to keep learning how money, investing, and the US financial system really work, subscribe to Mind of Wealth. Because when you understand the system, you can make smarter decisions for your financial future.